Now, I can tell you right now, folks, obviously I'm no economist, but I'm really good at math and I have a lot of common sense. And by the way, I understand the obvious. This chart, this is what you call a barcode chart. It's the Federal Reserve, right? And all the different recessions that we've had. Now, remember, the Federal Reserve was created with the stated intent. They promised when Wilson signed off that they would end the wild, crazy cycles of the business cycle, right? No more booms and busts. And you can see, I mean, we had some big ones in the 1800s. We had 4 major disasters. We had some big ones after the Fed, but I will say this, for the most part, the duration of these have been much slower, and they've been shorter than in the past, and they've actually been more spaced apart in the past. Now, some of that, by the way, is Fed policy. Some of that's fiscal policy, but here's the rub. Now, here's the most important part. The end result has been that while we have fewer recessions and they're shorter and the economy comes back stronger, Main Street has been getting a smaller and smaller piece of the action, right? This is labor's share of GDP going back a long time to the early 50s. And I can tell you right now, most of this has happened since 2000. Now, I will admit, it's been wonderful, absolutely wonderful for investors. I mean, take a look at this. Profit margins have gone through the roof. And if you look really closely, the big spikes come after recessions, right? They just go higher and higher. As profit margins go higher, the stock market goes higher. And by the way, this 2009 spike, that secular bull market that began in March of 2009, we're still in it. It's not over, folks. The problem, though, is that the middle class has been hollowed out since the 80s in particular, right? Late 70s, 80s, it began. And okay, initially we saw folks moving to the upper brackets, more folks moving to the upper brackets than the lower brackets. But those labels don't really mean much in the real world, right? Think about this for a moment. It said that one needs $136,000 minimum to live in New York City, but less than $42,000 to live in upstate New York. I say what? Go to New York City and tell that to the folks there, and the folks in upstate New York can say that, and they both will laugh in your face. They certainly wouldn't crack a smile. If they did, it wouldn't be a nice one. There is more than one America, folks. There's more than one consumer. Poorly assessing the strength of the American consumer, I think, is one of the biggest mistakes it makes all the time, right? And this is it. Look at this. Look at the spending growth. The light gray line are the richer folks. Look at the wage growth. The light gray lines are the richer folks. Their numbers are going up. Everyone else's numbers are going down. Oh, by the way, when the market opened today, guess what the number one stock in the market was? WSM, Williams-Sonoma, where rich folks go to shop. So yeah, on the surface, it looks wonderful. It looks beautiful on the surface. As for other influencing news today, the gas field strike in Iran, I agree with Larry. I heard Larry talking right before we came on. It underscores superior air power that America and Israel has over Iran, and other financial networks that keep suggesting we're losing this are doing their audience and the American public a major disservice. Okay, it sends oil prices higher. We know that, but that's only temporary. Now, my next guest says federal officials will feign confusion about making policy through a fog.